Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. I was talking to one of my close friends last night and we haven't seen each other for a while. He started investing in the stock market, crypto kind of thing, just when I started early 2020. And then obviously the crash happened, all that stuff, and everything just went up from there onwards. We have spoken about a couple of stocks here and there. We don't have the same strategy. So for him, it's always been investing in penny stocks and things like that. But last night we went out with a couple of other friends. We're having a conversation about stocks and all that stuff. And he's telling me he's down £20,000. I was like, what? What do you mean you're down 20,000? More than, he said, more than £20,000. And I was really shocked because I was like, what have you done? He's like, and that's just the stock side of it, because he's bought a lot of crypto as well. That's still down. But yeah, I was really surprised, and we were having a conversation. I was like, what happened? And he was telling me he bought this stock, some lab company, pharmaceutical company that's selling some sort of a product to other companies and stuff. And it was below, I think, $1 per share or something like that anyway. And he bought about £1,000 worth of shares, and then he started buying more and more and more because it kept going up, and now he's down 90% on that stock. It's about £20,000 down in just one stock. And he said he's got a couple of others that are down as well, and a little bit of crypto. And I was really shocked because I thought, like, we haven't spoken about in detail what was been happening in his life. And I think I've a couple of times of one of the brothers in the groups, couple of the brothers in the group, in our community, have actually mentioned that they're down quite a bit in the last few weeks. But £20,000, more than £20,000, that's a lot. That's more than half of what I have in here. Okay. Luckily, I am up for a bit, like 6%, 7%. That's not beating the market, but that's still good enough for me to, like I said to you last video, I was up at one point, I don't know, £6,000 or something, and now it's half, not even half that, less than that. So yeah, it's a strange market, but you really have to be careful. And then we start talking about what, going forward, what you should do, the fact that you shouldn't listen. Like, he's basically in loads of different groups, that, like, WhatsApp groups that basically trade a lot of these high flying kind of stocks. And now he said almost everyone in the group are down. Some of them are down about 100 grand. So it's a lot of money to play with. And I just thought, you've got to be really careful. And we talked so much about stocks and basically stuff like that last night. And he was saying to me, I wish I listened. I wish I basically did what you did. And I was saying to him, listen, you can still make money, right? You don't have to basically, tenfold the year. Like, you don't have to double or triple your money every single week. It doesn't work that way. It's more about the long-term plan. So we sat down, we talked about what do you want to do in the future and so on. So what is your plan? Do you have a long-term plan that you want to achieve? And if that's it. If you have a long-term plan, then how are you going to get there? What is going to take you there? Like, are you looking to double up your money every year? Or are you looking for, decent 10%, 7 to 10% every single year? And if that's the case, then there's so many stocks that you can buy, so many great companies out there that are undervalued at the moment. And that's what I want to share with you guys today. So companies that have a moat and are undervalued at the moment, according to Morningstar, according to other companies. And when you talk about moat, for example, or wide moat, what that means is this. Okay, so economic moat means, and basically an economic moat is a distinctive advantage a company has over its competitors, which allows it to protect its market share and profitability. And that's important. And that's what we talk about all the time. We talk about companies that could potentially have a competitive advantage, right? That are undervalued at the moment, that have a great balance sheet, that will whether there's we're in a recession or whatever the case might be. Okay, and this is what we're going to look at today. So I'm going to look at 5 different companies today, and I'm going to share with you another few more companies, but I'm going to focus on 5. But I will show you some of the other companies that have a wide moat are undervalued according to Morningstar. I'll share the whole list at the end. But I just wanted to do this video because I felt like we talked about it with my friend Dice, and we was just saying like going forward, are you going to sell? Are you going to hold? And he's saying basically he's going to hold on to it because there might be this and that. And then we talked about the fact that you should now start investing in companies that have earnings, basically positive earnings, are well now, and this and that. And he's got, mashallah, he's got 3 beautiful children. I said, that's what you should be working towards, is just put something in place for them, InshaAllah. God knows how long we're going to be around, but InshaAllah, if they're around, they will benefit from like your investment today. You don't want to lose £20,000 or over £20,000. That's crazy. So yeah, let's get to the video. I'm going to share with you 5 companies that we could potentially add to our portfolios, or maybe already in your portfolios, that are undervalued at the moment, that have a wide moat, competitive advantage. And honestly speaking, these are the type of companies that you want to own, especially in a situation where there's a recession possibly coming up, or maybe the market crashes, or whatever the case might be, okay, or inflation is going up. This is the type of companies that you need in your portfolio. And the first company we're going to look at is Adobe. Okay, Adobe is one of the companies I own in my portfolio. For the year, it's down about 4.5%. A year to date is about 16.5%. In the last 6 months, about 24%. And when you look at just this month, is down almost to 10.5%. And just this week, it's down about 7.7%. Now, I'm going to show you, just to give you the details of the company. I'm sure you know what Adobe does, company that owns Photoshop, Adobe Premiere, and all that stuff. Great company, have been around for a long time. They have a positive cash flow. So let's have a look at their financials first, and then I'll tell you whether it's undervalued and so on. So the market cap is $233 billion. In terms of PE, it's about 34 at the moment. They have positive earnings of, like forward earnings of $13.79, and from the height, so the basically right now is actually heading towards the lows, okay, in the last 12 weeks. The high was almost to $700. So at some point this stock was almost $700, and right now it's only $420 per share. Now we're going to look at the financials and see if basically how I'm using Morningstar. I'm using the free version, so I'm not paying for anything here. Okay, so as you can see here, the revenue is beautifully growing. The total revenue from 2017 to right now is growing the right direction. So from $7 billion to now $15.8 billion in there. You also, when you look at the gross profit, is also growing the right directions, from just $6 billion about 5 years ago to right now almost to $14 billion. Cost of the revenue, okay, it's also kind of going up in a little bit, but it's not as much. So the cost of the revenue is $1.9 billion. Let's call it $2 billion, right? And the total revenue is $15 billion, almost $16 billion. So they're spending about $2 billion to make $16 billion, which is absolutely amazing. So for the last 5 years, as you can see, they've been doing an absolutely amazing job. So from $7.3 billion in 2017 to right now $15.7 billion. This is the type of companies that will spend a lot of money, obviously, for research and things like that. So if you look at the operation expenses, especially for selling, general and expenses and the admin expenses, you can see it's about 5 points. So it's growing, but not as much as obviously the revenue, because the top line is great. And then when it comes to research and development, again, that's also growing. I don't mind this for technology companies because they need to innovate, obviously. So that's absolutely fine. And finally, the net income. Okay, so this is the money they take after they pay all the expenses and so on. That's beautifully growing. And 2020 was a good year, almost $5.3 billion of net income. 2021, it came down about to almost to $4.8 billion. So not bad, not massively, but obviously maybe it's a COVID related, maybe the sales were not great. I don't know what's happened there, but not much, obviously. As you can see, it's not massive. So if you look at it from 2019 to 2020, so you're looking about $3 billion to $5.3 billion. So it grew massively. So again, to come down is normally, it's a normal thing, basically. Just one more thing, the basic EPS or earnings per share. So from 2017, it was about $3.43. Right now we're looking about $10, which is really good. I mean 2021, and then forward it looks like it's going to be about $13 per share. So really good. So a solid company, again, great balance sheet overall. They don't have a lot of debt. They're planning in terms of, according to Yahoo Finance, the sales will be growing about 13% this year, almost 14% in 2022, and then 2023 almost to 15%, which is really great. They are, when you look at their current year, so they will expect it to grow about 10%, next year about 18%, next 5 years, every single year in the next 5 years is expected to grow about 15%, which is huge for this huge company. Okay, and as you can see here is 1.8, so it's definitely a buy. And the analyst for Yahoo analysts basically are saying $660 per share. That's what they expect it to be, and right now it's trading $473 per share. Couple of more things. If you look at simply Wall Street is undervalued about 12%, and they expected the prices to be, this is the wrong company. Yeah, I knew that was the wrong company. That was Apple for whatever reason. So Adobe is actually undervalued about 50% right now, ish, according to Simply Wall Street. They expect it to be $965 per share. That's huge. I wish that's true. And according to Tip Ranks, is a moderate buy. So you got 17 analysts who said it's a buy, 6 are saying hold, no one is selling, and they expect the price to be $667 per share, and that's almost a 41% upside. So again, it's a great company, solid business. So that's the first one. Right, so the next company we're going to look at is Clorox. This company was beaten up in the last couple of weeks. So for the year, it's down about almost to 22%. A year to date is about 17%. Last 6 months, about 13%. Just this month, almost to 20%. And just this week, actually it's gone up just this week, but the last week, 2 weeks ago, has actually gone down because of the earnings report and because they came out and their guidelines were actually not that great. Okay, so it's one of the businesses that I've used to own before. I sold it because Zoya made a mistake and they made it non-compliant and I had to sell it. But then I'm thinking of buying it back, but right now maybe not a good time. I'm just gonna assess the situation first and then see. But it's definitely a solid business if you think about it generally. So let me go over the market cap first. So that's about $17.4 billion. They do pay dividend, and I'll come back to this in a second. And this is probably one of the reasons I'm a little bit hesitant to buy it. But the PE is quite high, 33. That's really high, and that's forward PE. And the earnings per share is only $4. Okay, and when we look at the financials from the last 5 years, what you will notice is, in terms of growth wise, it's actually heading in the right direction, especially if total revenue. And then you've got they spending about $4 billion, and they're making about $7 billion. So they're spending quite a bit of money putting back into the business. And this is one of the reasons why it actually went down the other day, because they came out and said the cost of the material that they need in order to create their product is actually going up. And for that reason, their profit margins will be basically squeezed a little bit. And if you look at this as well, it's obviously the profit margins is $3.2 billion, which is excellent to see. Couple of more things. So the net income, the total net income here, okay, when you look at it, not bad, but it's in the millions. Okay, and remember, Clorox, even though it is a very well-known business, is only about $17 billion business. Basic EPS, okay, you can see it's growing in the right direction. Just last year. Okay, right. So this is the problem, right? Last year, because 2020, because of COVID, this company has seen a massive rise. Okay, everybody was buying their product, all these wipes and stuff. But obviously, 2021, it had to come back down. So from 7.5, almost $7.46 billion to only $5.65 billion. So, and for that reason, a lot of obviously people have sold that out. Now let's have a look at their dividend, and this, because this is really interesting. If you look at their payout ratio is over 100, and this is a little bit concerning. I wish they cut their dividend and basically spend the money on growing the business instead of paying a dividend right now, because Sometimes you want to own a great company, not just because of the dividend, because of the growth side of things. Okay, they've been paying their dividend over 44 years. They've basically grown every 5 years, whatever, almost 7.5%. But this is not right. So this means they're borrowing money or they're using debt to pay off that dividend. So that's not great. Right, so the next thing is if you are patient and they don't cut the dividend, again, there's too many ifs, this year you might not make any money. Okay, the business is not going to grow the sales side of things because they probably have to, the cost of the materials will probably be too expensive. But next year, you're looking at about 3.5. And again, this is the type of business that grows about 4% to 7% every single year. And the next couple of years, if you look at the next year, it's expected to grow about 37%. But the next 5 years, not so much. So for now, it is a hold. It's not a buy for me. I will probably buy it if it goes below 100. Okay, but right now, I would pass this company. If you look at it according to Simply Wall Street, as you can see here, it is almost to 42%, over 42% down. They're basically saying should be $248 per share. And that's it really from this company. I genuinely don't think I should add it to my portfolio. Just wait, maybe if it goes, like I said, if it goes below 100, then it might be a good buy. Oh yeah, one more thing. According to TipRanks, it's actually a moderate sale at the moment, and the price they're saying it should be $148, about 3% upside. But like I said before, they've only got 1 buy, 4 hold, and 9 sales at the moment because of the forecast. You wonder why I've included this actually in the list. I'm wondering why I included this in the list. Because it's a great company. I actually do like it. I thought the numbers, I don't normally check the numbers beforehand, but I think this one, looking at it now, I checked all the others. I expected this to be better, but hey, there we go. It's not that great, but the dividends, I don't think is that safe. Although dividend safety is about 75%, and they're paying over 3%, I don't think this is sustainable. I don't think that they need to cut this off a little bit to make sure they can pay off their debt and everything else, to be honest. Right, so the next company, we're just only going to spend a couple of minutes on this one because it's Microsoft. They're a great company. I've talked about this so many times. For the year, it's up. For the last, basically, year to date, it's only 12% down. Just 6 months is up. For the 1 month, it's down. And then the last 5 days is almost down 3.56%. Now, over $2 trillion business here. You've got a yield of 0.84. They pay $2 and dividend rate basis $2.48 per share that you own. P slightly higher at the moment, but earnings per share is absolutely brilliant, 9.43. If you look at the financials, I've talked about this company so many times, so I'm not going to spend a lot of time. You know what Microsoft does and what the company is doing. So look at that beautiful. Okay, look at their cost. Yes, it's kind of going up, but obviously their revenue, total revenue, looking at about $168 billion. Okay, and then you look at their only $52 billion of that is actually the cost of it, and then they got gross profit of $115 billion, almost $116 billion. So great company. They spend a lot of money on their basically research and development and things like that. When you look at their net income, okay, it's beautifully growing, especially last 3 years. Earnings per share is definitely growing so much in the last couple of years, and I think it's just heading in the right directions from now on. When you look at their what the analysts think, so sales growth is about 18%, then 14% the following year, and when you look at their next 5 years, they're growing about their business about 17%, which is absolutely brilliant. According to the Simply Wall Street, they're undervalued at the moment, almost to 40%, should be about $480 per share, and according to TipRank, is actually strong buy at the moment. Even according to Morningstar, it is actually still undervalued. So you got like almost a 27% upside if you bought this stock right now. And when you look at the Microsoft in the Simply Safe dividend, is 99%. Because that dividend is so small, and the fact that they've got so much cash, and they're growing their dividends about 11% every single year, well, That's absolutely brilliant. So they grew that 2020 September, they grew their dividends about 11%, which is absolutely brilliant to see as well. Right, so the next company is 3M. You know 3M is in my portfolio as well. It's in the industrial sector. They sell almost everything from Post-it notes to God knows what. They've got so many different brands that are very well known in the world. So yeah, they are in the industrial sector. Amazing company. They've been around for hundreds of years. And when you look at it this year, they're down about 10%. A year to date, just again about 10%. In the last 6 months, almost to 21%. And just this month, about over 10% down. So something has happened recently where I think they're getting sued, or there's some sort of a legal thing going on. So for that reason, it was down quite a lot just this last couple of weeks. The company market cap has a market cap of $91 billion. They do pay some nice dividends over 3%. And their PE is right now about 15 base points, which is very, very low if you think about it. And then you've got EPS of $10.39. Now, when you look at quickly, let's have a look at their financials. Again, like I said, I'm using Seeking Alpha for this one. So total revenue is beautifully growing in the right direction. Gross profit is also growing in the right directions. Their net income, the same thing. Okay, basic EPS, it was only 2019 they were down, but the rest of the years they're heading the right directions. When you look at their dividends, for example, it's about 75% safe. That's the 3.74% of dividends. They don't grow the dividends a lot, but again, it's fine for me anyway. And when you look at their growth, sales growth for the next couple of years, it's about 3-something%. This is the type of business they buy other businesses. That's how they grow normally. Organic growth is quite slow normally. So you got that. And then when you look at the current year, they're growing about 2.4%. And then next year about almost 7%. And the next 5 years, you're looking at about 7.5%. I'm happy with that. Yeah, really happy with that. I mean, 7% every single year for the next couple of years. But at the moment, according to Yahoo Finance, is a hold, okay? Because you only have 4 analysts that said it's a buy, and no one is saying it's a strong buy, and 7 have said that it's a hold, and 3 have said it's underperformer. No one is actually saying it's a sell. So yeah, their price target is 182. Right now it's 159. For me, it's definitely a buy. I'll be honest with you, right? And if you look at the Simply Wall Street, 35% undervalued, it should be about $250 almost dollars per share. According to Tip Ranks, which is quite similar to Yahoo Finance, analysts are almost saying the same thing. It still has 13% upside, which I am happy with because I've already got shares in this business. I'm going to keep adding to it in the next few weeks because it's actually a great company. They pay excellent dividend as well. Right, so I was planning to do 5 stocks, but I think the video has gone too long. So I want to quickly show you, I'm going to leave those 4 as they are, but I'm going to share with you quickly the list that Morningstar came up with. So this is companies with wide moat, meaning they have a competitive advantage and they are undervalued at the moment. And this is the type of business that if you include it in your portfolio, that you're not going to worry about, you're going to sleep well at night. Because I was talking to that brother, I was talking about the story that I was saying earlier, and we were saying basically one of the things that you should be doing is buy companies and stocks that you don't have to worry about. Like you don't have to worry about them ever again. You buy them, you hold it, you just leave them there. And he was saying, I wish I had like that mentality early on. And I was saying, let's work together. Let me show you what I've been doing and then I'll share that with you. So anyway, as you can see here, you've got 3M on the top there, 4 stars. 4 stars basically means cheap, 5 stars even cheaper. Okay, 1 star is too expensive and 5 is too cheap basically. You got Adobe, you got a couple of other companies. ASML Holdings is, I think they are based in Netherlands. They are chip makers, or they have equipment to make chips and so on. They're undervalued at the moment. Clorox is another one that's in, as we talked about. Ecolab, really good business as well. I think is one of the stocks that I looked at it not long ago, not in the YouTube, but I was doing a bit of research. I don't know I might look into it. Emerson Electric is another company that I used to own before. JSK, again, GSKs, and what else is in here? Medtronics, 4 stars. Merck, again, 4 stars. RB, one of those UK based companies as well, really good. They sell a lot of products, especially cleaning products as well. You've got Rocher Holdings, which I think is Dutch as well, or Swiss, I think, company, 5 stars. Salesforce is the one that I want to do a little bit quick analysis, but we talked about recently, so I'm going to leave that out. But it's a 5-star stock right now, and it has a wide moat. It has massive growth. So look at Salesforce again, using the stock companies that I shared, the websites that I shared with you guys. ServiceNow is another similar to Salesforce. They're in sort of the same industry. You've got Starbucks in there. I'm not investing in there yet. Well, I'm not going to invest ever again in there. I bought one share, I think, when I first started investing, and then I found out there was a couple of issues with it. They sell pork and all that stuff, so I left it out. TSM, great company, 5-star right now. I own it. Not sure what to do with it yet. Slightly a bit concerned. And then Unilever. My concern for this company, by the way, before I move on, is the situation between Taiwan and China. And the fact that I can't buy it in my ISA account. I want to own a lot of these stocks in about 10-15 years from now on. And I don't want to pay a lot of taxes if I have a lot of capital gains. So I don't know what to do with this. I might have to sell it and see if I can buy it in another ISA account. I don't know what I'm going to do. We'll see. Unilever is one of the companies that I own, and the rest of these companies I don't really know. So yeah, there's the massive list of stocks that have a wide moat that could be around for a long time, could be potentially a great value or great stock to add to your portfolio. I hope you enjoyed the video. If you lasted this long, this was not my intention, but if you lasted this long, just give me a thumbs up, okay? Let me know if you have any questions. I appreciate you guys. Love you. Take care. Assalamu Alaikum.